If you ask most people a simple question, which country's rate hikes matter most to the global market? Most people will answer the United States. Some will say Europe, very few people will say Japan. Because in most people's minds, Japan is quiet. Decades of low interest rates, chronic deflation, slow growth, a country that seems disconnected from global finance. But in reality, the opposite is true. If Japan truly begins a sustained rate hiking cycle, the impact on global liquidity may be more direct and more disruptive than actions taken by the Federal Reserve. Why? Because Japan is not a global demand center. Japan is a global funding source. To understand this, you need to forget GDP rankings for a moment. Japan's importance in the global financial system does not come from growth. It comes from three structural facts. First, Japan has long been one of the world's largest net external creditor nations. In simple terms, Japan has lent more money to the world than the world has lent to Japan. Second, Japan has operated under ultra-low interest rates for decades. Not for a few years, but for an entire generation. Third, these two facts together turned the Japanese yen into one of the most trusted, cheapest, and most stable funding currencies in the world. This means something very important. A large share of global investment activity is ultimately financed with yen. This is often described as the yen carry trade. The logic is straightforward. Borrow yen at near zero interest rates in Japan. Convert yen into dollars or other currencies. Invest in higher-yielding assets elsewhere. Those assets include U.S. Treasury bonds, U.S. equities, emerging market debt, real estate, risk assets across the globe. As long as two conditions hold, this structure works. Japan's interest rates stay low. The yen does not appreciate sharply. For decades, both conditions held. And gradually, the world developed a dangerous illusion. Liquidity always seems abundant. But this is only the surface. If you zoom out further, you see something more important. The yen carry trade is not an isolated strategy. It is the foundation of a global interest rate differential system. Global carry trades work on a simple rule. Borrow where rates are lowest. Invest where returns are higher. For many years, the structure looked like this. Japan at the bottom, cheap funding. The United States in the middle, attractive returns. Emerging markets at the top, risk amplification. Capital behaves like water. It flows downhill toward yield. And Japan has long been the lowest point. Now comes the critical question. What happens if the lowest point starts to rise? This is the real meaning of Japan's rate hikes. If Japan enters a sustained tightening cycle, the foundation of global carry trades begins to shift. For yen-funded investors, three risks appear at the same time. Borrowing costs rise. The yen may strengthen. Overseas asset volatility increases. This creates a dangerous equation. Interest costs rise. Currency risk rises. Asset prices become unstable. When risk overwhelms return, capital does not hesitate. It does only one rational thing: close positions. Sell foreign assets. Convert back to yen. Repay debt. This is not panic. It is mathematics. This is why Japan's rate hikes equal global liquidity withdrawal. Because the money is not inside Japan. It is spread across U.S. equities, U.S. government bonds, emerging markets, high-yield credit, cryptocurrencies, global real estate. When carry trades unwind, liquidity disappears everywhere at once. So where is liquidity pulled from first? The answer is clear: U.S. long-term Treasury bonds. Japan has historically been one of the largest foreign holders of U.S. long-dated treasuries. For Japanese institutions, banks, insurers, pension funds, long-term treasuries made sense. Relative safety, stable yield, hedged currency exposure. But once Japanese domestic rates rise, this logic weakens. Hedging costs increase. Domestic assets become more attractive. Foreign bond exposure becomes less necessary. As a result, Japanese capital reallocates away from long-dated treasuries, back toward domestic balance sheets. This matters because long-term U.S. treasuries are not just American assets. They are the global risk-free benchmark, the foundation of asset valuation, the discount rate for global capital markets. When long-term treasury yields rise or become volatile, equity valuations compress. Mortgage rates rise. Emerging market capital flows reverse. Risk assets reprice globally. Japan's rate hikes transmit through U.S. treasuries to the entire world. You might ask, if the risk is so large, why does Japan signal rate hikes so far in advance? Because the Bank of Japan understands something deeply. Markets fear unexpected shifts in expectations more than policy changes themselves. A sudden rate hike would cause a sharp yen spike, forced liquidation of carry trades, global asset fire sales. That would not be adjustment. That would be a systemic accident. So Japan's strategy is not to avoid tightening. It is to stretch the shock across time, through gradual signaling, forward guidance, careful expectation management. This allows global capital to unwind positions slowly, not violently. This explains today's environment. Markets appear calm on the surface, but volatility is creeping higher. Liquidity is tightening quietly. This is not a sudden drain. It is a long, controlled withdrawal. Now connect this with the previous episodes. The Federal Reserve is easing, trying to stabilize the system. Japan is tightening, pulling capital back. One central bank is adding liquidity. Another is removing it. Global liquidity is effectively fighting itself. That is why rate cuts feel weaker. QE has diminishing impact. Markets remain unstable. The conclusion is simple but powerful. Markets are not driven by headlines. They are not driven by emotions. They are not even driven by single policies. They are driven by changes in interest rate differentials and forced global capital reallocation. Japan's rate hikes are not a local event. They signal a structural shift in the global funding system. When the foundation moves, everything built on top must reprice. If you want to understand macroeconomic changes early and prepare before trends fully form, please subscribe to the channel.